Here's what nobody wants to admit. The stock market is living on borrowed time, and next week's inflation data could be the reality check that changes everything. While Wall Street celebrates another record high for the S&P 500 index, closing at unprecedented levels just this Thursday, seasoned investors are quietly whispering about a troubling truth. September historically crushes stock performance more than any other month over the past 3.5 decades. Yet here we are, acting like gravity doesn't exist. September has been known to see a wearing down of the sentiment picture, warns Matthew Miskin, co-chief investment strategist at Manulife John Hancock Investments. But here's where it gets controversial. Stocks aren't pricing in a lot of risks right now. They look fully valued. Translation, we might be in for a rude awakening. The week ahead brings a perfect storm of economic data that could shatter the market's current euphoria. Thursday's Consumer Price Index report takes center stage, followed by Wednesday's Producer Price Index data. These aren't just numbers on a spreadsheet. They're the smoking gun that will determine whether the Federal Reserve delivers the rate cuts Wall Street is desperately banking on. And this is the part most people miss. The market has become dangerously addicted to the prospect of Fed intervention. Following Jerome Powell's late August comments about rising employment risks, traders have been betting the house on monetary policy rescue. Fed funds futures are now pricing in a staggering 90% probability of a quarter-point rate cut at the September 16 to 17 meeting, with some even gambling on a more aggressive half-point slash. Friday's employment report threw gasoline on this speculation fire, showing job growth stumbled in August and pushing unemployment near 4-year highs. Suddenly, traders are dreaming of nearly 3 full rate cuts by December. That's about 70 basis points of easing for those keeping score. But here's the million-dollar question everyone's avoiding. What happens if inflation refuses to cooperate? Only a CPI number that comes in egregiously higher than estimates could dent assumptions of imminent monetary policy easing, admits Art Hogan, chief market strategist at B. Riley Wealth. That's a pretty narrow tightrope the market is walking on, don't you think? Recently, Miskin points out, the prospect of the Fed cutting has been the overwhelming factor driving equity sentiment to be more positive. And so, if that reverses, then it could be problematic for equities. Problematic might be the understatement of the year. Meanwhile, a ghost from the past has returned to haunt investors: tariff uncertainty. Just when everyone thought the trade war fog was lifting, a U.S. appeals court dropped a bombshell ruling that most of President Trump's tariffs are illegal. The Trump administration is now racing to the Supreme Court to preserve these sweeping trade measures, injecting fresh chaos into an already jittery market. It felt as though the fog of trade war was clearing, and now we're just back into the thick of it, Hogan observes with obvious frustration. And that doesn't help corporate America make decisions, consumers make decisions, and investors make decisions. The tariff drama isn't just about trade policy, it's about cold, hard cash. The potential loss of tariff revenue could balloon the U.S. fiscal deficit, which partially explains why long-term government bond yields exploded higher earlier this week. The 30-year Treasury yield actually touched 5% for the first time in over a month, a level that historically makes risk-taking much less attractive. Adam Turnquist, chief technical strategist for LPL Financial, doesn't mince words. That 5% yield threshold has been problematic for risk appetite in recent years. While yields have since retreated to around 4.78% following Friday's weak jobs data, the damage to investor confidence may already be done. Here's what should really worry you. The S&P 500 has surged approximately 10% in 2025, driven largely by solid second-quarter earnings. But the index is now trading at 22.4 times forward earnings estimates. That's a massive premium compared to the long-term average of just 15.9 times earnings, according to LSEG DataStream data. Anthony Saglin-Bain, chief market strategist at Ameriprise Financial, cuts through the noise. Investors face ongoing threats from trade and tariff unknowns, as well as potential economic releases that could ultimately challenge elevated stock valuations. But then he adds the kicker. That said, investors have been navigating those dynamics for months, and stocks have continued to grind higher. So, here's the uncomfortable truth nobody wants to discuss. Are we witnessing the final chapter of irrational exuberance? Or is this market really as bulletproof as it appears? With inflation data looming, tariff uncertainty resurging, and valuations stretched to uncomfortable levels, next week could provide some very uncomfortable answers. The question isn't whether these risks exist, it's whether investors are prepared for what happens when reality finally catches up with expectations. What do you think? Are we heading for a correction, or will the market continue defying gravity? The comment section is open. Let's hear where you stand on this brewing storm.